Amazon drops hard after hours. Tech stocks follow. Suddenly, everyone's asking the same question. Is this the moment the AI trade finally breaks? Let's slow this down calmly and look at the facts. So what actually happened? Amazon reported earnings that looked fine on the surface. Revenue beat expectations. AWS grew more than 20% year over year. But the stock dropped anyway, nearly 10% after hours. Why? Because Amazon shocked Wall Street with its future spending plans. They told investors they plan to spend around $200 billion in capital expenditures in 2026, far more than analysts expected. That single number changed everything. Markets don't trade on the past. They trade on what comes next. Here's the simple version of why that spooked investors. Spending money is easy. Making money back is harder. Amazon is telling the world, we're investing aggressively in AI, data centers, robotics, and infrastructure. That might pay off beautifully 5 years from now. But investors were expecting improving cash flow now. Instead, they got a warning: profits may be delayed. So traders sold first and asked questions later. That's classic market behavior. This didn't stay contained inside Amazon either. Microsoft slipped. Google pulled back. Tesla weakened. Semiconductors dropped even harder. Why? Because Amazon's announcement wasn't just about Amazon. It signaled something bigger, an AI spending arms race. If Amazon is spending $200 billion, Microsoft and Google can't stand still. So suddenly, investors started recalculating margins across the entire tech sector. That's why everything moved together. This wasn't company-specific. It was narrative-wide. Now for the big question: is this a real market top? The short answer is it's too early to say. What we do see is profit-taking, valuation compression, and fear spreading fast. What we don't see yet are collapsing earnings, broken business models, or credit stress. Right now, this looks more like a violent repricing than a structural breakdown. Markets often overreact first and then think later. Charlie Munger always said, "The big money is not in the buying or selling, it's in the waiting." He also warned us about exciting stories. AI is real. But exciting stories often hide uncomfortable economics. Munger would ask 3 questions. Who benefits? When do profits arrive? And what can go wrong? If you can't answer those calmly, you're probably speculating, not investing. So let's go name by name and see what this means. Amazon, a great business with massive ambition but near-term uncertainty. Microsoft is still dominant in enterprise cloud, but it's also spending heavily on AI. Google has strong earnings and cloud growth, but it's also guiding to much higher spending. Tesla is less about cloud and more about vision, but risk-off markets punish everything. Micron and other semiconductors are leveraged to AI enthusiasm. They rise fast and they fall fast. None of these businesses are broken, but valuations are being reset. That's an important difference. So, what should a rational investor do in the next couple of weeks? First, expect volatility. Second, don't make emotional, all-or-nothing decisions. Third, use a scaling approach. If you like these companies long-term, consider buying slowly. Not all today, not all tomorrow, but over time. If something feels too big to hold comfortably, reduce your position size. Munger believed peace of mind was part of risk management. Looking ahead, watch 3 things. 1. Do tech stocks stop making lower lows? 2. Does volume shrink on down days? And 3. Do companies start explaining when all this AI spending will turn into actual profit? If those factors stabilize, the markets can too. If not, the volatility continues. To close, Amazon didn't crash because its business failed. It dropped because expectations changed. That happens in every market cycle. Charlie Munger would remind us, volatility is not risk. Poor judgment is. Stay calm, avoid stupid mistakes, and let time do the heavy lifting. Thanks for watching, and remember to subscribe for more insights.